Hi, I'm Louis. Digi, one of Malaysia's largest telco counters, is it worthy to be invested? Profit and dividend distribution. Between financial year 2012 to 2021, Digi's revenue was almost constant. On the other hand, its profit before tax and profit after tax were decreasing gradually. Likewise, it is shown in this figure that between financial year 2012 to 2021, Digi's earning per share had also been on a downward trend. During this period, dividend distribution was consistent. However, in the last few years, the amount of dividend distributed was lesser than before. Between financial year 2012 to 2021, Digi's dividend yield had also been on a downward trend. In financial year 2021, Digi's dividend yield was 3.7%, which was slightly higher than FD rates. In financial year 2012, Digi's annual dividend payout ratio was very high at around 170%, while between financial year 2013 to 2021, Digi's dividend payout ratio was mostly around 100%. This shows that the company was paying out almost all of its profits to shareholders in the form of dividends, which makes Digi one of the highest dividend payout company in Malaysia's stock market. Management efficiency. Between financial year 2012 to 2021, Digi's net profit margin was decreasing over time. As the company's profits were decreasing over the years, between financial year 2012 to 2021, both of Digi's return on assets and return on equity were on a downward trend. Stock valuation. Between financial year 2012 to 2021, net tangible assets per share of Digi was almost constant at around RM10 cents. On the other hand, during this time period, Digi's share price was decreasing. It appears that Digi's share price is not directly linked to the assets value of the company. By comparing Digi's share price and earnings trend, it is shown that there are some correlation between its earnings and share price. Between financial year 2012 to 2021, it is shown that Digi's earnings were decreasing over time. Likewise, its share price was also decreasing with time. This shows that the share price is influenced by the company's earnings to some extent. Price to book ratio is calculated by dividing share price with net tangible assets per share. Lower price to book ratio, especially lower than 1, is preferable. This shows that the share price is undervalued and has room for upward movement and worthy to be invested. Recently, Digi's price to book ratio has been on a downward trend, indicating that its share price is becoming cheaper over time. Although now that the share price appears to be cheaper, the price to book ratio is at around 50 times, which shows that the share price is still at a relatively high point. PE ratio is calculated by dividing share price with earning per share, which shows the ratio between the share price and the earnings of the company. If the ratio is very high, it shows that the share price is at a high point, which is not worthy to be invested. Between financial year 2012 to 2021, the PE ratio of Digi mostly ranged between 20 to 30 times. In 2021, Digi's PE ratio was at around 27 times, indicating that the share price is still relatively high. The market cap is calculated by multiplying share price with the number of shares. Hence, higher share price will contribute to increasing market cap and overall valuation of the company. In the last few years, Digi's market cap has been on a downward trend, indicating that investors are having a lower valuation on the stock. By considering the number of shareholders holding the stock, it is shown that between 2015 to 2019, the number of Digi's shareholders was decreasing. On the other hand, in 2020 and 2021, the number of shareholders were increasing, which might be due to lowering share prices that attracted more interest from investors. Digi is also well supported by institutional investors. Its largest shareholder is Telenor Asia Private Limited, holding 49% of total shares, followed by EPF, Amanah Saham Bumi Putra, Kumpulan Wang Persaraan, and so on, also holding significant quantities of shares. Due to its large market cap and stability, Digi also attracted significant interest from foreign investors. In 2021, foreign investors were holding on average 10.3% of Digi's total shares. Financial management and stability. Between financial year 2012 to 2021, it is shown that Digi's capital expenditure spending was almost constant at around Rm 800 million per year, indicating that the company has been investing significantly in property, plants, and equipment in order to expand its capacity and reach more customers. Between financial year 2012 to 2021, it is shown that Digi's equity was almost constant, while its debt level has been increasing over time. In the last few years, its equity to liability ratio was below 1, indicating that its debt is relatively high. Between financial year 2012 to 2021, it is shown that both of Digi's current asset and current liability were almost constant. In the last few years, its current ratio was below 1, indicating that the company's short-term debt level was relatively high. This could be a risk factor that might be detrimental to the company's financial stability. Between financial year 2012 to 2021, Digi's cash flow was between Rm 0.2 to 0.7 billion, which is a lower cash flow amount compared to Axiata and Maxis. Although the equity to liability ratio and current ratio show that Digi's debt level is relatively high, note that Digi's customers are mostly bound to mobile network services contracts, and they pay monthly for the services provided. This leads to a stable source of cash flow for Digi, which enables the company to maintain stable and healthy finances. By considering its cash flow per share, it is shown that in financial year 2021, Digi's cash flow per share was Rm 3 cents, which is around 0.7% of the current share price. In conclusion, in the last few years, the market competition between telecommunications services providers has been intense, which led to the decreasing profits of Digi. In addition, its dividend yield has also been decreasing in the last few years, down to around 3.5 to 5%. However, Digi's market cap is large and its financials is stable. Now its PE ratio is about 20 times. Do you think it is worthy to be invested in? Also worth mentioning is that Digi's main business activity is providing mobile network services, which currently serving up to 10.3 million customers. Its main source of revenue stems from its customers' prepaid mobile network service packages, which make up 40% of its total revenue, followed by revenue from postpaid packages, contributing 39% of its total revenue, and finally, revenue from its devices and other services segment, which contribute 21% of its total revenue. That's all for today. Feel free to share your thoughts in the comment section. See you next time. Bye! The content above is for sharing and reference purpose only. It is not an investment recommendation. Investors are encouraged to carry out further research and analysis, as well as follow up latest update information before making any investment decisions.